Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we have great data. We're going to talk about CPI, Consumer Price Index, PPI, Producer Price Index. We're talking about interest rates. We're talking about inflation. We're going to talk about housing and all the key things about what's going on with housing. And we have a ton of data. Most of it comes from Bureau of Labor Statistics and things like this. The government that measures all of this. We have great charts too.
Right. And we will try to make it interesting and not bore you. If you need 2 cups of coffee, we totally understand.
Yep.
If you need some chocolate thrown in there, I totally hear you. I do too. I was eating chocolate while I was researching this, so I hear you. I completely hear you. But first of all, we have to get to the important part. We are marching toward our 1,000th video. 1,000 videos. That's amazing. Yeah. We're less than 20 away, and we would like to hear from you. So in the comments, we would like for you to tell us, after we get to our 1,000th video, do you want this nearly daily video deluge from us? Or would you like us to put out videos maybe only 3 or 4 times a week? What works better for you? Do you feel that our quality would be improved if we put out less? Is the quality that we're giving you sufficient? Is it good for you? Let us know. We're very interested in your feedback because we will absolutely consider it as we approach our 1,000th video and figure out how we proceed from there. Now, let's get the good stuff. Let's get to the charts.
Okay, so the first chart we're going to talk about is CPI and PPI. And these are basic. So the CPI is, or the inflation numbers. These are the numbers that the government is looking at to determine what the level of inflation is, like how much stuff costs, Consumer Price Index.
Yes.
Okay. Producer Price Index is showing it's a leading indicator. Why is it a leading indicator?
Right, because this is how much it costs the producers to make things. So the consumers are the people who buy the things, and the producers are people who make the things that the consumers buy. So when the cost declines for the producer to make things, now the producer has a couple choices. They can, 1, pass on that savings to the consumer, or 2,
or cost.
Or cost. But in this case, we're talking about a declining producer cost.
Yeah.
Okay? So in this case, we're talking about a declining producer cost. So the producers can pass on that cost savings to the consumer, because certainly if their costs go up, a lot of times they will pass on the cost to the consumer because they can't make whatever it is at a sustainable level in order to keep making whatever it is. But if it costs less, then do they pass that to the consumer? Do they fatten up their bank account or their reserves? Those are some choices that they have to make. And so it's kind of exciting to see when the producer price index goes down, because if it goes down long enough, then even those producers that were maybe saving for like a rainy day fund, even they would probably go ahead and back down on the price. Because if they don't, then somebody else will come into the marketplace and produce whatever it is that they're producing for less money and pass it on to the consumer. And then, of course, they won't do well in those instances.
That is, there is a natural economic effect that does not include monopoly companies, companies that have actual monopolies, where you have this massive barrier to enter. You're unable to enter and really compete against another company. As you can see,
think energy companies, right? So your water company, your power company, your gas company, these are monopolies.
Airlines are monopolies. Apple is a monopoly. You can't look, if you just can't really go create your own smartphone. You just can't create that whole ecosystem of an app store and that operating system and connect it to all the phone networks, because they're not going to let you do it, right? You just can't really. That's something that's very difficult to do. It's arguable that it's easier to create a space company right now than an airline, because you can't create an airline, because even the startup airlines are having a hard time getting pilots and getting, especially pilots, right, to work. So let's talk about this chart a little bit, okay? Orange line, producer price index, the blue line, CPI. As we talked about, the PPI actually is a leading indicator, because it takes a while for producer inputs to end up to a consumer outcome, right? So let's give an example. Let's talk about this as an example, okay? Energy costs have gone up, and you have an airline that's now paying more for fuel. They have one of two choices. They can raise fares to make you pay for that because they want to remain profitable, or they can leave fares the same and either make less profit or lose a little money because they don't want to give up market share. So that would be and although their producer price index for them, for their cost of their good has changed, the CPI doesn't change because the CPI is going to be more tied to what people are paying for airline tickets, right?
Good example, yes.
Right. Okay. Now, let's talk about housing. Housing costs. We're talking about rents and mortgages are actually, because the CPI is not just, it's based on the total amount of money spent. So if you spent like gym memberships, if gym memberships go up 10%, the CPI doesn't go up 10% because gym memberships are this really small amount. You probably pay $10 a month, now you pay $11 a month, right? But it's based on how big, if a thing is a bigger cost to you, and housing is the biggest cost, right? Okay, what percentage, Juana, would you guess that housing is of the CPI? All housing costs?
40%.
It's 40%. It's, depending on what metric they're looking at, it's 36 to 43%, whether it's rent, costs of mortgages, costs of maintaining your home, but your housing costs are about 40% of the number. And as you can see, this number took off really in 2021, and that was largely what was really driving this. Was housing was driving this more than anything.
Right.
Was driving. And then of course you could say, well, what producer price index was? Well, producer price index was being driven by energy, which isn't affecting housing as much. But remember, the cost of building supplies and things were going up. And remember, the raw materials for housing was causing new homes to be much more expensive.
Right. So, we had supply issues as far as the, getting the timber there, getting appliances and all of that. And then as far as the energy costs were concerned, of course, it cost more to ship things because your washer and dryer, your refrigerator, your trusses aren't made on site, right? They have to be shipped. So that also increased the cost.
The second largest cost for PPI, for a company like that, for example, would be labor. So you have labor costs, you have...
right, so the labor costs were another thing. So we were coming off the pandemic where people had either gotten out of construction or they were still getting assistance. So it took a while for those workers to get spooled back up and be back on the job.
Yeah. Okay, so what we're going to do now is, you've seen how the CPI is cooling, the PPI is cooling. Looks like we're on the back end of this thing. The last estimate for the Fed was like 2/3 they would raise it a quarter point and 1/3 they would hold it steady. We're not going to find out for like 2 more weeks.
Right.
It's about 2 weeks before we find out what they're going to do. My guess is that they'll raise it a quarter point and then sit on it for a while, make sure they've stamped out a lot of this inflation. They want to kill spending off still, which is really what happens is they're choking off spending because people have less access to credit cards, short-term loans, and it chokes off a lot of spending, right?
Yeah, I think we still have probably 2 more upticks, but we'll see.
Okay, now what we're going to do is, you're probably saying, well, this is a housing channel. Why are you guys talking like economists? Well, because I went to graduate school, got an MBA. I like talking about this sort of esoteric, big picture stuff. But now we're going to talk about just housing, okay? This is from the MBS housing survey for April. The April survey of loan officers and real estate agents showed another big jump in buyer activity levels and sentiment. This marks the 4th straight month of improvement. So this is the survey for April, but they're asking them in April. This is April now. So it's not the whole month of April. Let's just ask them in April, what do you think about what's going on? 4 months in a row, we saw this start to improve. 68% of respondents characterized their local buyer activity as very active, somewhat active, or steady. It was 56% in March, and it was 19% in November of 2022. It's substantially. So these people are saying, hey, it's like, this is not puffing, because only 19% in November said it was very active, somewhat active, or steady. That meant 81% of people said it's not very good, like it's bad. It was below steady. Only 19% even said it was steady. So you got 68% are like, hey, this is either a normal market or it's pretty good.
Right. So this is really important because we've talked about this, that buyers come back in the spring. Now, does this thing have legs? Our argument is that it probably does, because we're at kind of the tail end of the interest rate hikes, and people have become accustomed to this. And you see this in the markets too. The Fed had the last 2 raises of interest rates that Fed did not negatively impact interest rates as far as mortgages. Mortgage rates actually went down because the market factors in what's happening long term, not short term. So these Fed interest rate hikes are not necessarily going to hurt housing. Like Todd said, they will impact other loan products, for example, credit cards, auto loans, things like that, but not so much housing, because housing has kind of decided that we're at the tail end of it, and they're looking down the road, and they're looking at lower rates down the road.
Okay. So what all this means is, we're going to go to the next chart here. This is trends in home list price. This is from MBS Highway Housing Survey, and this is a group that just basically grabs a bunch of data. They do surveys and do other things. But what they found was that if you look at this chart, 33% of list prices, the trend is the same. It's neutral, right? Mm-hmm. But what was interesting is that the moderate price reductions and moderate increases are about the same, meaning if we had looking at this chart back in August, September, it would be mostly red with some yellow and almost no green at all, right? This thing has shifted substantially. It would be fun to see this in a chart like over the last year, right? Because certainly if we'd looked at this 18 months ago, this thing would be green, mm-hmm. right? And certainly last probably February, March, it would have been pretty much mostly green. Mm-hmm. And then the other interesting thing is we've only 2% reported significant price reductions, but 5% have reported significant price increases. You're dealing with a lot of multi-million-dollar type stuff. Mm-hmm. Anecdotally, tell us about deals that have fallen out and then come back right on the market at substantially higher prices, just without being too specific.
Right. So either they've come back on the market. So let's say that you've got a house and it's $100, and it's sold for, let's say, $98, but they didn't close escrow for whatever reason. They backed out. The house comes back on the market at maybe $101. Maybe it sells for $102, or maybe it sells for $100, but it sells for more than what it previously went under contract for, maybe 6-8 weeks ago. So, of course, this is not happening on every property, and it's happening on a few. But it's just interesting to see that, because when you kind of look at the overall market and you're saying, hey, this is happening on 5% of properties, that kind of gives you an idea that there's something going on in the market. And the reason I pick 5% is because that's actually the number that the title company sent out. I think this morning, that 5% of the listings actually had a price increase in our market.
Yeah, there was a price increase in the market. The reason why I picked on the higher end homes is because it's that market in Las Vegas seems to be the most active, which is unusual, right? And a lot of these people are cash buyers, but we're seeing these deals, 7-figure deals, mm-hmm. fall out of escrow, and then they went under contract a month or two ago, and now the houses are going back under contract substantially more. It's like, it's not unusual to see a house under contract $100,000 more than it just fell out of contract.
Yeah, so it's weird.
It is definitely pretty weird. During the last housing debacle, Juan and I, over, let's call it 5 years, sold about 3,000 listings. Mm-hmm. We did not see this activity. Like, this was not something that happened back then. If we fell out of escrow, there was a good probability most of the time it came back, we actually would do a price reduction and put it back on the market. Right. Like, usually, there were times it fell out of escrow just because the market was kind of falling, and they said, hey, I can get a better deal on some other property. And even if they have to give up their $1,000 of EMD, they were better to switch and go get something else sometimes. Right. Okay, that happened. Okay, here's the last one. This is the average 30-year fixed rate mortgage. This data was current as of the 13th of April, 6.42%. Now remember, this is the average, and this also includes that they didn't put any points down. A year ago at this time, it was 4.99%, so it's basically like 1.4% higher. It's not ridiculously higher. It's much lower than the peak, 7.37% October 20th. There was a recent loan in February, it got down to 5.99, actually got quoted in February 5.0% on on a 30-year. Now remember, FHA and VA, if you're a veteran, a VA, you're going to get a much lower rate than this going rate. All the VA loans right now are probably quoting about 5.5%. And then there's other adjustments you can make based on that. So this idea that we were talking about interest rates would crush the housing market and choke off all the buyer demand, it really hasn't happened. And what happens in a normal interest rate increase? How long does it happen, and what happens afterwards?
So normally interest rates go up for about 18 months, give or take, and then they start to go back down. And we're heading toward that right now, because remember, interest rates started to go up a little over a year ago. So by the time we get to this fall, we will have hit that 18-month benchmark, and we'll probably see some interest rate reductions. We'll also see that probably because of the season when there's less economic activity, and the Fed will be trying to stimulate the economy a little bit, most likely. We'll also be a year away from elections, and not that it's political, but let's face it, there is a certain component to that as well. So in all likelihood, we will finish the year at probably a lower interest rate than maybe we started with. So that's obviously going to have a huge impact on housing, because we've talked about this before. There are lots of buyers sitting on the sidelines for two reasons. One is the lack of inventory, and the other is interest rates. So when either interest rates moderate a little more, or there's more inventory, you'll see a lot more buyers flood the market. And if those two happen to coincide, it's going to be the Wild West all over again.
I think next year could be very interesting. When Wanda says interest rates, she's talking about mortgage interest rates. Keep in mind this, that when we had a 7.37% with the median, 30-year fixed, the Feds even since then has still raised mortgage rates about 1.25%. But you can see that mortgage rates aren't 8.5%. They're like 2% lower so the Fed is not raising mortgage rates. The Fed is raising short-term rates. That affects the market for rates. The 30-year mortgage rate is more closely tied to what the 10-year Treasury is doing, because when you're an investor and you're investing money, you're basically given a couple choices. What do you invest your money in? You could put it in a money market, which generally doesn't pay very much. You could put it in a 10-year that usually pays more, and it's secure, it's guaranteed by the government. You're going to get that percentage over 10 years. Or you can put it in a mortgage-backed securities. But remember that mortgage-backed securities, even though they're a 30-year, these things get refied. So you may have invested in a package of mortgage-backed securities, but if people, as they refi or sell the houses and those get extinguished, you don't get to continue to collect that interest rate. So just because somebody went and got a 7.37% mortgage in October, and you said, "Oh, I'm going to invest in that mortgage-backed security because it's backed by all these houses and it's pretty secure." And even if one of the 500 houses in the whole package gets foreclosed, I don't really care, because we'll just recoup most of that money anyway when we sell it. But remember, the problem is most of these people have already refied, right, Juana?
Right.
Like the refi boom, we actually, when we went from that 7.37 to 5.99%, we had a massive refi boom in January and February.
Right, yeah. So the housing market is very dynamic. And that's kind of what we're trying to show here, is all the different pieces that contribute to it. So when you hear somebody who's making a statement based on just one piece of the puzzle, be careful and look at the whole picture, because the whole picture is what determines the market, not just one piece. We are on our way to our 1,000th video, as I said before, and we would like for you to come along with us. Please subscribe, hit the notification bell, share the video, leave us a note. Tell us what we did well. Tell us what we can do better. Tell us if you'd like us to make shorter videos, longer videos. If you want to keep going with a video a day, 3 or 4 videos a week, what works for you? We want to hear from you. We do read your comments and we appreciate them.
Yep.
And we'll see you on the next video. Bye.
Bye.